Hey, good morning, everyone. Thanks for your attendance today at Demystifying the Index of Universal Life Insurance on the index side. Today we're going to focus a little bit on sort of the back testing of how illustrations look and get a better idea of how to design these products, especially when you're trying to compare two products side by side. It's important that you have proven back-tested strategies, and you're really comparing an apples-to-apples approach, and not just using, random numbers to, assume performance down the road. So today is going to kind of focus on that, get our heads wrapped around it a little bit, and get us really close to actually putting this product in front of our clients in the near future. So with that being said, we're going to let Chris jump into this and take it away.
Thank you, Paul, and thank you, everyone, for taking the time to be on our webinar today. This is the fourth installment of our Demystifying IUL series. As Paul mentioned, this is our effective illustration tips, and he let you know kind of what we're going to be going over today. So with that, we'll get going here. So our agenda today is we're going to look at some illustration tips, some historical look backs, and as Paul mentioned, comparing illustrations and products with other carriers. So on some illustration tips, with the North American products, we have two different options. You have your Guideline premium test or your cash value accumulation test, or CVAT. You also can have an increasing versus level death benefit option. What you want to make sure is that you have an adequate face amount. As always, this is life insurance, so we want to make sure that we're fulfilling those death benefit needs. If an individual wants to take out a loan or withdrawal, make sure that the timing is correct for what they're looking for, and the length of the income stream. You want to put all those factors in play when you're doing an illustration. So for illustration tips, if you're wondering between Guideline premium or CVAT, both still have the 7-pay modified endowment test, the MEC test. Guideline premium has premium limit, so it has either the Guideline single or the Guideline level. And then on your CVAT, monitors death benefit size relative to the account value. Higher death benefit required for Guideline premium corridors. Just to kind of get into these two options a little bit, most of the illustrations we run here are the Guideline premium test. And the reason is, on CVAT, even if you're running it for the 7-pay, the IRS is really great about a change in the product. If there is a change in the death benefit because of the cash value accumulation test, even if you run an illustration and have that illustration not be a MEC, some things could happen within the policy itself that could turn it into one. We've seen it happen. And it's just because the IRS has really great guidelines on changes in a policy, like structural changes to the policy. Now, when you're running CVAT, if it is a situation where we use this a lot for one of our sales concepts called the smart money, where we're basically taking large sums of money, putting it into a product, making it a MEC, so that's fine, and just utilizing it that way. And normally on CVAT, you just run with the level pay. You don't do increasing. Whereas the Guideline premium test, when you run that one, sometimes you can run it at increasing death benefit, sometimes you run it at level. Just really depends on how the policy is going to work out. But like I said, most of the cases, if we're trying to solve the policy to not be a MEC, we do run the Guideline premium test. And here's what I kind of mentioned before about the level or increasing death benefit. So primary objective, of course, as we always say with the life insurance, is to meet the death benefit needs of the client. An increasing death benefit allows a smaller face, raises Guideline level premium amount, and it's, like I said, not helpful when minimizing face for a CVAT test. Consider changing increasing to level in the year following the last premium. So changing the death benefit is a material change causing a new 7-pay test. And that's kind of what I was referring to before in the CVAT. With the material change, it can cause a MEC. Now, normally, when we're running illustrations on, say, a guideline increasing, a lot of times that's for maximizing cash value in a policy to take out max loans later down the road. So, for example, let's say we're running an illustration on a 45-year-old male. We would do an increasing death benefit because that would lower the death benefit, and let's say he pays until age 65. So you run the increasing death benefit for 20 years. After the last payment, you make it level, and you can start taking out your loans. Now, you are only able to go in and move that once, from either level to increasing, which really never happens, or level to increasing, or increasing to level. I'm sorry, really doesn't go level to increasing. So, but you can only make a change once. So that's why you want to make sure you do it after that last payment, and then you're able to, once you hit level payments, you start taking those loans out. It's not going to try to increase that death benefit to keep the cost of insurance a little bit lower. So that, obviously if you have a smaller death benefit, that is going to mean, smaller target premium, but a lot of times the difference in what the client's going to get on the loans and the cash value is kind of a big difference. So I always like to run those both ways when we're solving for an income level. Do it increasing, one level, see what happens. So as we had said before, we want to make sure that we're getting an adequate face amount. We want to make sure we're meeting the client's life insurance needs. Yes, life insurance and specifically IULs are great products for cash accumulation, for taking out loans or withdrawals, helping supplement retirement, all those things. But at the end of the day, when our underwriters are sitting there looking at the policy, they're looking at that death benefit. Does it meet the client's needs? We want to make sure that we're not, if we're out there selling and let's say the person has a $500,000 term, and we say, you know what, you can just get into an IUL, let's just replace that term. Well, we don't want to sell them a $100,000 IUL, even if it has increasing premium, if they needed that $500,000. So we want to make sure we're doing right by the client as far as death benefit. The second bullet point there says leave room for premium growth. So, sometimes when we're selling these IULs, there may be money, as we get older, we hope we have more disposable income to put away for retirement or things of that nature. If we're running these illustrations at minimum death benefit for max cash value, a lot of times there's not a lot of extra room in there for additional premium. So how do we get around that? Well, you can show actually in the software premiums increasing down the road, which is great because that will raise the death benefit, therefore raising the target premium. Or you could fund it, instead of funding it, say, at Guideline or solving for minimum face at, max cash, which is going to run at a Guideline, maybe you solve it for a minimum face or minimum premium for a face, or you're just paying a little less. That'll give your client a chance to put more money in there. So there's a lot of different options there, but just, like we said, you want to be able to give your clients some flexibility on the premiums, because if they, if we solve for a minimum face max cash for, $100 a month, and 5 years down the road they can say, hey, I want to, increase this to $250, well, there may not be any room, and if something happens to their client's health, they're no longer maybe insurable or insurable at the rate they got before. So basically what, when you're designing the product, just straight up ask your client, do you foresee down the road being able to add more money to this policy? If they say, no, I think this is good, well, there you go. If they say, well, we might be able to, show them a couple different options. So here's just kind of an example of a policy. So you have $4,800 going in every year, and then our illustration software does not allow us to show premiums and loans the same year. Could you do it? Certainly. We just don't allow to show it because we don't want any policies that are being hyperfunded, but they still can go in. But in this case, you can see how that loan would work. Here we're using a male, age 45, preferred non-tobacco, using an 8% illustrated rate, our loan rate of 5.9. So you can just see that, and that's on a $260,000 death benefit. So you want to consider the duration of the income stream. May or not show more income if stopping before age 100. So, in this illustration, we're showing the income going, all the way through to age 90. Where you really see, where you're going to know if it's going to matter if you run it to 100 or if you change it to a different age. Normally, we run all of our income streams, if they start at 60, 65, 70, what have you, we run them to 100. Now, how are you going to know if it's going to be better to shorten that up? If you look at where the death benefit is, once that starts increasing, that is when you will know where it would be short. So here, you can see the death benefit going down, 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 and then in year 32, it starts to go back up. So let's say instead of running income to age 100, you decide to do it to age 80, then your premium will probably be a little higher. So that's just kind of the easy way to know what age you can cut that off at if you're running that illustration. You want to show a little more income and not run it all that way. So another important thing that we use in our illustrations, of course, is our historical look back. All companies use that. We use a 30-year look back, and we use that for our maximum illustrated interest rate. And we use it on all of our different, whatever, bucket you want to put it in. It has a different max illustrated rate that you can use. Our default is our S&P 500 annual point-to-point. It currently is at 3.2%. So, really what we do there is it uses every trading day of every day of the year at the current cap and par rate. And right now, like our annual point-to-point is at 13.5 cap with 100% par. And we use a geometrical average. And, so what does that mean? So, like I said before, we use our current caps, floors, par rates for the 30 years. We calculate the annual return for each of the past 30 years for the first business day of each year. Then we take the geometric average of step 1 to produce the average annual return for money invested on that date. We then repeat steps 1 and 2 for each of the following business days. We take the average of the 30-year annual returns for all the business days within the year to show the overall geometrical average rate. This produces a 30-year look back, which is our maximum illustrated rate. And as you can see, a geometrical average is typically used when you're talking about investments. So it really has a better overall picture of how the market really produced over that time. When arithmetic average, we just add up all the values and then divide it by the number of values. Whereas the geometric average, we multiply the values and then raise the power of 1 divided by the number of values. So that's a lot of math there, and really we're going to get into how that looks. So an example of 5 returns here. Let's say we had a return of 90, 10, 20, 30, and a negative 10. With the arithmetic average, it would be a 28% return. With the geometrical average, that would be a 24% return. So using $100 as an example, you'd see that the arithmetic average would show, the dollar amount there, the 343.60, whereas the geometrical shows the 293. So what you're saying is, hey, Chris, that's great. That's a ton of numbers. What does that mean to me? What we're saying here is that it's not a more conservative approach to how we do our caps. It's a more realistic approach. So even though your arithmetic average might look like it's going to produce a better return, it may not, because it's not taking all the factors into consideration. That's really what we're saying here, is that with our caps and our par rates, we're giving you a better example of what the last 30 years did compared to another company that doesn't use the geometrical average. And even at that, using the geometric average, a lot of times our max cap and caps are still higher than a lot of other carriers. And that's where I want to come to talk about this particular slide. So as Wald mentioned, we're comparing apples to apples, and we have a great a piece out there that actually has an apple that's got a slice cut out, and it's an orange inside. And really, when you're comparing products, they may be priced different to support different caps. Our particular products are priced so we can have the high caps. So consider illustrating the same look-back rate period or the same % reduction from rate. So if a company, most companies I think out there have a 30-year look-back, but some may only have a 20. If that's the case, you want to make sure you're doing a 30 to a 30. Or the same % reduction from rate. So let's just say that you have an agent that likes to show 7%. Just show me at 7%. I used to get that a lot when I worked at an MGA. You know, compare this company and this company, run them both at 7. Well, you know, in theory that makes a lot of sense. But what if one company's max rate is 7.5 and North American's is 8.2? Well, that's not a fair rate. So what you can come back and say, hey, I'll run, you know, either North American at 7, but then reduce the other company by the same %, or on the other company at 7 and North American at a little higher. It gives you a better apples to apples idea of what's going to happen out there in the real world. Because if you know, the other company, say maybe their annual cap's only at 12 and ours is at 13.5, well, you can do the math there. You max out a couple times, the North American policy is going to do much better in the long run. You want to consider the variable interest loan rate. North American has a variable loan which is capped at 6%. That is a cost that is built into our product. So right now, if someone was to take a loan, they'd be taking a loan out of their policy for only 4%. But what happens down the road, say, you know, 30 years from now, interest rates are up. Our max rate is 6%, and we currently illustrate at 5.8. So what's that mean if you're showing these, you know, showing our product in an illustration with loans coming out compared to another company? Well, if another company is using current variable loan rate at 4, and we illustrate at 5.8, because that's, once again, a 30-year look back on the bond, they're going to look better. But in 30 years, what if interest rates are at, say, 8%? They may or may not have a variable loan rate cap. Well, if they're illustrating at 4, 30 years down the road, your client wants to take a loan out, now interest rates are 8, I don't need to tell you that's going to make a huge difference in how that it was illustrated and the amount of money they thought they'd be able to get as to what they're actually going to be able to get because of that high loan rate. Whereas North American, if it's at 8%, we illustrated a 5.8 cap at 6. Worst case scenario is we're going to charge you 20 bips more than what we illustrated. Huge difference there. Another factor is to check age nearest or last. Our IULs are our builder, and our is a actual age product. Some are nearest age. Well, don't need to tell you that if you're younger, costs of insurance are going to be a little lower. So keep that in mind. You also want to make sure you match policy years and premiums for the loans or withdrawals. Some companies do it a little different. If you have, say, a 45-year-old male and want to start taking income at 65, you just want to make sure that you have this in each policy you're comparing, that, you know, let's say the premiums are going in for 20 years and not 21 or 19, and that the loans or withdrawals start the same year and go up for the same number of years. So, you know, some companies do it a little different, so just be mindful of that as well. And you want to look for design elements such as index selections, flexibility, riders and benefits, interest rate bonuses, death benefit guarantees, you know, etc. You know, with North American, we have 13 different index selections on our builder IUL. Obviously, there's a lot of flexibility in most ULs and IULs. Riders and benefits, you know, our chronic and critical and terminal is on our builder and our guaranteed builder. The chronic and terminal is on our rapid builder. You know, interest rate bonus. We have a contractually guaranteed interest rate bonus on the index selection for all of our IULs. You know, death benefit guarantees. We have, you know, products that have a death benefit guarantee out of the chute, or you can purchase a portion of a death benefit to be guaranteed, you know, as a rider. So, you know, a lot of different things just to consider other than the, okay, here's my premium going in, here's my death benefit, here's the amount of loan I'm going to get possibly 25, 30 years down the road. There's just a lot of other things to take into consideration when choosing a product. And obviously company considerations, the integrity, rating, things of that nature. You know, we're A+ rated 92 Comdex. We've never raised cost of insurance on an in-force North American block of business ever. So, you know, you have those things to hang your hat on, that the policy you're pitching is going to be, you know, what we try to do is just by the time that the client wants the policy to do what they intended it for, you know, in this case, if it's for, say, retirement supplement, that it's going to look as close to the illustration as possible. That's really what we strive to do here. So with that, here is my direct contact information. I am here Monday through Friday. We're Central Time from 7:30 to 5 on Monday through Thursday, 7:30 to 12:30 on Fridays. There's my extension of 36326 and my email address. And you can also contact anyone over at Pinney that can help you out as far as designing a case as well. So with that, I would welcome any questions that may be out there.
Thanks, Chris. You have a few minutes to address Chris if you got any questions. We don't see any questions at this time. All right, I appreciate everybody coming out to the call today, and we look forward to seeing you again.